Picture this. It's late. You've been watching the charts all day. One of your coins, let's call it Hyperwave, starts to pump. It's up 15%. You feel that surge, that little hit of dopamine. You take a screenshot. Maybe you share it in a group chat. You feel smart. You feel like you're winning. Now, picture a different screen. It's a spreadsheet, or maybe just the total at the bottom of your portfolio tracker. That number, the one that matters, is down 3% for the month. How is that possible? How can you have winning trades, feel like a genius, and still be losing money? Here's the uncomfortable truth. You're probably not being outsmarted by the market. You're being bled dry, slowly and silently, by something else, an invisible tax. My name is Sam, and I want to show you how the average retail trader's portfolio isn't killed by one bad bet. It's eroded by 100 small, seemingly trivial leaks that you've been trained to ignore. Let's start with the most obvious one, but we're going to look at it in a way you probably haven't. The fee fog. You see an exchange advertise a 0.1% trading fee, and you think, that's nothing. That's just the cost of doing business. But that fee is the tip of the iceberg. The real cost is in the shadow economy of transactions that happen before and after that trade. The on-ramp and off-ramp. Buying crypto with your card? That's an easy 3 to 4% gone right at the start. A wire transfer might be $25 flat. Selling back to cash on most platforms, there's another spread, another fee. We mentally account for the trade fee, but we treat all these other costs as just background noise. The toll for entering the casino. But the real killer, especially if you're doing anything beyond just buying Bitcoin on Coinbase, is gas. On Ethereum mainnet, a simple swap isn't free. It's a $5 to $50 transaction, depending on how busy the network is. And that's not a percentage. That's a flat tax. It doesn't matter if you're swapping $100 or $10,000. The network wants its $15. Now, let's scale that up to a year of what feels like normal activity. Let's say you're an active user. You're not a degenerate gambler, you're just engaged. You make maybe 3 swaps a week across different DeFi protocols. You stake and unstake your tokens once a month to chase slightly better yields. You claim a couple of airdrops. Seems reasonable. Let's do the math. 3 swaps a week at an average of $15 gas each. That's $45 a week, times 52 weeks in a year. That's $2,340. Just in swap fees. Then you have 12 stake or unstake actions, maybe $20 each. There's another $240, a couple of airdrop claims at $40 each. Another $80. Add it up. You have just spent $2,660 in a year, not on tokens, on gas. Pure network fees. Poof, gone. Now what's the size of your portfolio? Let's say it's $20,000. That gas bill represents a 13.3% annual tax on your entire stack, just for the privilege of moving your own money around. Your portfolio needs to grow by 13.3% in a year, just for you to break even with where you started, before you've even made a single dollar of actual profit. That's the invisible tax at its most basic. And we haven't even talked about the price of the tokens yet. But fees are just the obvious leak, the one you can see on Etherscan. The more insidious leak is how your own brain and the design of the entire crypto space team up to make you poor. I call this the impatience premium. It's the compulsion to be fully deployed, to never have money sitting on the sidelines, to not miss out. This forces you to buy at statistically worse prices and sell at the worst possible times. Think about how this works. You see a coin start to move. You've been watching it, you FOMO. You take a $10,000 lump sum and you buy in, right at that moment. Now, let's compare that to a painfully boring, disciplined approach. Dollar cost averaging, putting in $1,000 a week for 10 weeks. In a volatile market, which one do you think gets a better average price? It's almost never the lump sum FOMO buy. The DCA strategy buys on the way down, it buys on the way up, it smooths out the volatility, it removes the emotion, and it removes the terrible timing. Let me show you with some simple numbers. Let's say a token's price over 10 weeks goes like this. $100, 95, 90, 85, 80, then back up to 85, 90, 95, 100, 105. If you FOMO your 10,000 at week 1, you get 100 coins at $100 each. At the end, at $105, your investment is worth 10,500. A 5% gain. Not bad. Now, the DCA person puts in $1,000 each week. Week 1, they get 10 coins at $100. Week 2, they get about 10.5 coins at 95. Week 3, about 11.1 coins at 90. You get the idea. By the end of 10 weeks, they've accumulated about 108.8 coins. At the final price of $105, their portfolio is worth about $11,400. That's almost $1,000 more, an 8.8% better return, just by being patient and systematic, instead of impatient and emotional. The impatient premium cost the FOMO buyer nearly 9% of their potential return. And it gets worse when you're dealing with illiquid altcoins. Buying a $5,000 position in a small cap token with a thin order book can instantly cost you 2 to 5% in slippage. That means the price moves against you just because you're buying. You are down 5% the second you click the swap button. That's not a market move. That's a tax on your impatience, on your desire to get in right now. So you pay a tax to get your money in, a tax to move it around, and a tax on your bad timing. But the real killer, the one that ties it all together, is what you do once you're in the game. The churn burn. High portfolio turnover is strongly correlated with lower returns for retail traders. Every single swap is a fee event. It's a potential tax event, depending on where you live. And it's another opportunity for your emotions to wreck your timing. Crypto culture loves the degen, the active trader, the NFT flipper, the person who's always in the mix. It feels productive. It feels like you're working your money. But the on-chain data tells a very different story. Look at a wallet that's constantly moving, with hundreds of transactions a month. Now look at a whale wallet. The whale moves deliberately, in large batches, with long periods of doing absolutely nothing. Inactivity is their strategy. Let's do the break-even math on churn. Let's say you're trading on a DEX. You pay a 0.3% fee per trade, and on the illiquid stuff you're facing about 0.5% in slippage on average. So per trade, it costs you about 0.8% to get in. To get out, it's another 0.8%. A full round trip buying and selling costs you 1.6%. That means your trade needs to go up by more than 1.6% just for you to break even. Now, how many trades are you making a year? If you're active, let's say you make 50 round-trip trades. Your portfolio needs to grow by 80% just to cover the cost of all that activity. 80% before you make a single dime of actual profit. You need to be spectacularly, unbelievably right just to tread water. Most people aren't. So the churn itself burns a hole in the bottom of your boat. I want you to think about two people. First, Sarah. She's 31, she's got a $15,000 portfolio. She's not gambling, she's yield farming. She's responsible. She moves her liquidity between pools to chase a 2% better APY. She bridges assets to new layer 2s for potential airdrops. She swaps her reward tokens every day to compound. She feels productive, like a crypto gardener. At the end of the year, her portfolio is at $16,000, a 6.6% gain. Not great, but it's green, right? But what if she did an audit? What if she added up every single gas fee, every bridge fee, every DEX fee? That number comes to $1,800. Her pre-tax, pre-fee gain was actually 18.6%. The farming activity, The constant moving consumed nearly two-thirds of her potential profit. She was busy farming fees, not yields. Then there's Jake. He's 24, a chart genius. He spots 10 small-cap gems over 6 months. Each one separately goes up 30%. He rotates his $5,000 through each one. He thinks, 10 trades, 30% each, I should be up huge. But reality hits. Each entry and exit costs him, let's be conservative, and say 2% total per trade in fees and slippage. His net gain per trade is closer to 26%. Compounded over 10 trades, his $5,000 becomes about $5,300, not the $6,500 he imagined. Those 30% winners, after the invisible tax, only yielded a 6% total gain on his portfolio. He would have been better off buying and holding just one of his own picks. This leads us to the most important part, the audit. You have to calculate your own personal invisible tax rate. It's not hard. The formula is simple. Take your total annual frictional costs. That's all CEX and DEX fees, all gas, all on and off ramp costs, and a solid estimate for slippage. Add it all up into one scary number. Then, divide that number by your average portfolio value over the year. Multiply by 100. That's your tax rate. That's the percentage your habits are slicing off the top every single year. Finding this number is brutal. It's humbling, but it's the first step to fixing it, because you can't manage what you don't measure. This number turns vague stress into a concrete problem you can solve. And solving it doesn't mean you have to become a hodl zombie. It means you have to become a sniper instead of a machine gunner. Every action needs purpose. Every transaction needs intent. You need to ask, is this move worth the 2% it will cost me? Is this potential 1% better yield worth the $30 in gas to move my liquidity? Most of the time, the answer is no. Here's the biggest aha moment in all of this. In crypto, inactivity is a strategic weapon. Every time you don't swap, don't bridge, don't chase the next shiny farm, you are saving 0.5% or 2% or 5% of your capital. You are earning a guaranteed, risk-free return equal to the tax you didn't pay. Doing nothing is often the highest yield strategy available. The goal isn't to eliminate the tax completely. That's impossible. The goal is to stop being its primary victim. When you understand the system, you can change your seat at the table. You go from being the one who pays the tax to someone who might actually benefit from it. How? By being the liquidity provider who collects the fees, by being the staker who gets paid for security, by moving deliberately, in bulk, when networks are quiet and gas is cheap. So here's your homework, and it's the only one I'll ever give you. Go calculate your number. Open your wallet history, your exchange statements. Add up every fee from the last 90 days. Extrapolate it out. Face your personal tax rate. That single act, that 10-minute quarterly ritual, will do more for your portfolio's health than finding the next 10 altcoin shills to follow. Your first step to keeping more money isn't finding the next 100x. It's finding the 5% you're giving away for free every single year without even realizing it. That's how you stop the bleed.